property taxes are up, labor's up, materials are up, utilities are up, interest rates are up, cap rates are up, and rents are up. And there's only one good thing actually on that whole list, and that's rent. So, it's a weird time, but with all of that, we're still finding cash flowing deals. That's a crazy thing.
So I had an opportunity recently to interview the amazing Ken McElroy, who's become a friend over the years. Just an amazing guy. If you don't know about Ken, he has an awesome YouTube channel. He has over $1 billion in real estate. He's just a great guy. He has his conferences. He's associated with Robert Kiyosaki, and he's got his books. So he's really in the education space, and he's also someone who's actually doing it. A lot of educators aren't people that are actually doing it, but I was able to talk to him and get information about what's happening right now. How does he see the market? What's happening with interest rates, valuations, rents, and construction costs? And I think you're really gonna like this interview because he really gets into a lot of this. So let's jump in.
There's no question that things have slowed down for us. We were talking a little bit before the show. I think all of us have experienced the same thing. There's been multiple reasons, and it's been no surprise. The one being interest rates. So I'll just give you one example. We had it's called low hundreds million in escrow on a deal, and we're in due diligence, and interest rates adjusted, and it adjusted so much that our interest payment went up so much that our cash flow went down, and we had to pass. So what's happening is these interest rates. This is one thing, of course. I'm sure these gentlemen here have lots of stories like that. But expenses are up, property taxes are up, labor's up, materials are up, utilities are up, interest rates are up, cap rates are up, and rents are up. And there's only one good thing actually on that whole list, and that's rent. So, it's a weird time, but with all of that, we're still finding cash flowing deals. That's a crazy thing. Some sellers are adjusting because they have to. The three of us here, we're pretty much underwriting similar deals the same way, and we're trying to get cash flow for our investors. And so if the cost of debt goes up, then we have to offer less on the price. And so that's what's happening right now. And so there's this push-pull going on in the market with brokers and buyers and sellers, and that's slowing things down. Well, if I knew completely, specifically Bronson, I would have a great couple of years ahead. But here's what I do think, because I have taken a position. And I've done that publicly on my YouTube channel, the Ken McElroy Official. And that's, I talked about a couple investor blind spots in two videos that I think are really important. One of them has to do with this. And if you look at Powell, the chairman, he's been really clear that their target is 2%. He's been super clear. That's been his narrative every single time, even the recent one in Jackson Hole that he said, our target's 2% inflation. Okay, well, as you know, it got up to 9.1. Now I think it's 8.5 or 6 or something. But so it did come down a little bit, but that's been with a lot of interest rate increases, back from March all the way to recently. There's another one this month, and then there's another one in November. So I believe that we're going to see a half point to 3/4 of a point. I think it's 20th or 21st of September. I think if hopefully inflation comes down into the 7s, maybe, and then I think we're going to see it again in November. But it's going to take a while, as this rolled out. It's going to take a while to roll back, and that's not necessarily going to be good for people holding on to bridge debt or floating debt or anything like that.
So here we are, October. We've had the September cap rate increase of 0.75%. Dramatically could potentially decrease multifamily inflation values. But there's also another risk too, right? Inflation is something that could eat up 40% of your wealth over a 2-year period if you just hold cash. Because if inflation is not 8 or 9 or 10%, if it's actually more like 15 or 18%, and you annualize that over 2 years, you've lost 35 to 40% of your purchasing power. So how do you navigate that? What do you do? What are the things Ken is doing? He's got some good things to say about that.
It's gonna slow the real estate industry way down. We're seeing it in single family. We're seeing it in our spaces, and we're seeing it across all lines. And so I think that he's willing to put the economy at risk to get that inflation, because inflation affects everyone, whereas interest rates only kind of affect, the people that are using, I guess, money, to buy things and or they're in debt. I just wanted to point out when, I've been investing since 2000, actually before that on a smaller level, but on a bigger level, this is our 20th year in business. And the federal fund rate then was 6.25. So, it's just the math has to work in all aspects, right? The only thing that's happening is we've been spoiled with these low rates, and now everybody's freaking out and trying to figure out how high they're going to go. I just want to say that the market functions quite well. From 2000 to 2005 was a nice little run too. I was buying during that time with these higher rates. And so back to your question on the bridge. So yes, we've done some about, obviously, as we all know on the call here, but I'll just explain it. If you're going to do a cash out refinance, you lean toward bridge because you want to capitalize on that value add that you're going to get. And the prepayment is really low with the bridge debt. So therefore, you're taking that interest rate risk for that short period of time. And then if you're buying something that doesn't necessarily have a value add, you put more of a fixed rate debt on it, but your prepayment's a lot higher, but at least you're hedging your interest rates. So the markets, as you guys have known, have had a lot of bridge debt in them over the last several years. And so I actually think this is going to be a problem for many people. And there's a couple other things. I don't think it's just a bridge debt issue. I think that it's also an equity issue. So there's a lot of equity that wants their money back. So if people that got money from big institutions, private equity, institutional equity, family office, whatever it is, that is behind that money, and I won't go into the waterfalls and how they all work, but that money is usually out 3 to 4 years, and so you have that issue where their equity partner is going to want their investment back. So they might be forcing a sale. And so that's the first trigger. And I think, like if you're partnering with a big company and they want their money back next year, they don't care. They want their money back. And then you as a sponsor is behind all of that. I think that's a big problem, especially if you have rising interest rates, because they're going to want, and so what could happen is a lot of these sponsors that use that kind of money, are sitting out there 3-4 years ago, they might not get anything other than fees from when they originally raised the capital and got the deal. And then you have the bridge debt reset. The interest rates are going to reset, so the cost of debt's higher. But the other thing that's higher, Bronson, we're seeing higher renovation costs, and we're seeing all kinds of higher things, and we're seeing higher cap rates. So depending on where you are around all of that, it could be when your property is, let's say, getting ready to market, if a cap rate goes from 4 to 5, let's say, which is not very far from what's happened, that's 20%. So you might get all of that through your NOI growth, but it might immediately be lost through that, through that cap rate going up a little bit.
So Ken says what we've all been seeing in the multifamily space right now, right? Cap rates are going up, valuations are going down. What should you do as a passive investor? And that's what a lot of people want to know. Where should I put my money? Should I do deals or should I wait? The confused mind will just say wait. He and the others on this panel, some amazing folks. This entire interview was awesome. Doing this panel, so you can check it out on this channel. But basically, he gets in and just says, try to find what a good deal is. Well, what's in place? Where's the margin of safety, right? As Warren Buffett would say, where are the things? How conservative is the operator being? And Ken has talked about that, in some areas of construction, there's a lot of costs that are just really, they're unknowable because costs are going up, they're increasing a lot. And there's some areas where they've had some setbacks as far as just really estimating what costs are going to be. So in this next section, he's going to talk a little more about, what does a good deal look like? What do you look for? How do you navigate and be cautious, but also don't just sit in cash or try to find the right deal.
So you have all these factors at play. And I think that properties that don't have a lot of reserves and don't have really good relationships with their equity are going to be in trouble. So, and of course, that could be That could be property to property. It could be within the same company. It just depends on the deal, not necessarily the sponsor. One easy thing that LPs can do, I think, Bronson, is to simply pull the business plan out and ask the sponsor where they are and go through the detail. Are you here with your CapEx? Are you here with your interest rates? Where are we on the expenses? Where are we on delivering renovated units, that kind of stuff? I know, we have 6 ground up construction deals too, and we're getting our butt handed to us on construction costs, and we're 7.5% over on one deal, and that's a lot of money. It's a $60 million deal, and so we're basically sending a letter to the investors saying, hey, my partner Ross and I put the money up, so we're not cash calling anybody, but we're you have to be that kind of transparency back as a sponsor, and not all of them will be. Some of them might not even know. So you gotta. It's simply just pulling the business plan out and saying, hey, these were the assumptions. I know that they might not all be true and accurate, but you got to kind of draw a line in the sand at some point. But where are we and where are you? And just open that dialogue. My frustration, one of my frustrations is a lot of our LPs, they don't ask very good questions or any questions at all. And I actually want them to. And I know these gentlemen here, and I've spoken at some of Buck's events. He's out there, we're out there educating our people, trying to tell them what's up. Not everyone operates that way. So I think it's important that they start asking questions on the deals that they're invested in, and then they'll get better. They'll ask better questions on the ones they're going into. So we have 68 million in renovations right now. And we have 6 ground up projects, all in the 50 to 70 million range. And, so we're seeing, they're very different, obviously, as you can imagine, but we're not seeing the operational labor costs going down anytime soon. I'm talking about the renovation guys on that piece. We're actually still having some issues on the supply chain for things like washers and dryers and dishwashers and microwaves and paint and whatever it might be.
So Ken talks about, as an LP or a limited partner, you should be asking good questions. And I thought that was really cool how he's like, hey, as a limited partner, you should be getting on calls and asking really good questions. Personally, in our business, Bronson Equity, I've had 1,300 one-on-one phone calls with investors, and a lot of people don't ask really good questions. And I think great questions are things like, what happens if things don't go well in this area? What's your cap rate at exit? What are you projecting there? What happens if costs rise? And then, in this next section, he's going to get into debt. What happens, if the cost of debt goes up? Is this deal, does it still work, or are there major issues with the deal? So let's jump into that.
It's month to month, project to project. It's been that way. It's kind of the new normal for us. I don't particularly see it being solved anytime soon. On the new construction side, actually, things are normalizing for us a little bit more, where, we're hiring, let's say, a framing company or a drywall company or whatever. We have had some issues on getting some of those things, including cement. And so we've had delays on time. And like I said, we haven't had higher construction costs, but we have also had massive run up in value. So, the property that we're building, the one I mentioned, is 40 million more than we projected it would be. So, and now that's not realized, of course, until you sell it or refinance it or whatever, but that's the appraisal. So, so if you have the cash and you're managing it, you're being transparent with everybody, you can say, listen, it's got up a lot more, but our costs are up a lot more too. And I think it's the same way with renovations. So, maybe what was 10,000 a door might be 12, as an example, but 12 times 1,000 units is a lot, or $2,000, dollars times 1,000 units is a lot. unless you've got it in the rent side. So I don't see it slowing down much. I think if it does, the new construction stuff, it's starting to settle down a little bit for us. But we're still having some issues on our one-off renovations. So I think, a couple things when you're raising it, if you're raising money and you're showing a lower cap rate, to Michael's point earlier, you could show anything you want. So we're not seeing lower cap rates. We're seeing cap rates gone up, at least in the last, many months. So what we've done is we're actually modeling it out a few different ways. So we're quarter, half, even a full point, just to see. Of course, we won't know where they are. There's I think there's a couple things to with your sponsors too, is that if we're not really net sellers, as Bronson, we're really long-term holders. So I've owned properties for 15 plus years. I'm on my third value add on some of them. First I watched rates go down, each time, and made me look really good. And now they're going up a little bit more, but we just did a big cash out refi on a property in San Antonio, 680 units that I've owned for 10 plus years. And so, I look at things very differently than, trying to time a cap rate in years 3 or 4. These are long haul. We're trying to, and I think a lot of us are trying to provide that coupon, to the investor, that monthly, cash flow. And then when time's appropriate, then we'll go harvest that money. Taking chips off the table is good. Like Michael said, you don't lose money taking a profit. And so, you should be doing those kinds of things, whether it's a cash out refi or even a sale, maybe to a 1031 or something. But for us, we don't really have capital gain issues. So, now, so if it's an IRR you're looking for, and that's typically institutional, very different than what we do. I'm more of a passive income, long-term cash flow guy. So we do pay attention to those, and we have to have them in our business plan. But we're often wrong, they're either higher or lower. So, but we do try. But I can tell you one thing: lenders and private equity guys are not allowing exit cap rates at lower than what you're buying. That's for sure. That does not exist. First of all, the number one driver for us is non-recourse. So that's the first thing. So if it goes to recourse, then we just say no. So that's just my own personal philosophy. I've seen market cycles take out people with recourse debt. So just from personal experience, I've seen that. So that's number one. So we are just in that box only. And I think, but there's a couple things on that cash out refi deal I mentioned earlier. The lender, after we got it all buttoned up and we figured out what we're going to do, they threw in two things. They threw in an interest rate reserve, which was very smart of them, I believe. So basically, they just said that we had to put so much on high ground for interest rates to hedge that bridge over time, but they held it, and a rental reserve. In addition to our budget, they had a rental reserve. And this is CBRE capital markets. So, so we're seeing that. And then on the stuff we're trying to buy, I don't know how about you guys, that we haven't actually talked about this yet, but we're seeing 55% loan to values. That's it. And I mean, you can step out of those products and go with something different. But again, getting back to that recourse, non-recourse piece, I would rather have more equity on the deal and more reserves and than the risk without them. Well, I always think that, I'm of the philosophy, there's the Dave Ramsey quote, which you shouldn't have any debt at all. I think it's, all of our whole portfolio. So we're right around $2 billion in assets right now, and we're right around 62% leveraged. So we're low, we're considered low leverage.
So Ken talks a lot about the idea of infinite returns, right? He has the Infinite Conference. He wears a t-shirt that says Infinite, and they love having properties that they can have multiple value add deals on. Some of these properties says they've done value add 3 times on them, and they just pull the money out and do new deals. And that's really a question a lot of operators ask is, should we just sell this and give money back to investors or refinance or kind of move on to the next deal, or to be able to do multiple projects? Well, I think as an operator, I think it's easier to hold on to a deal and to just simply keep pulling money out of it and keep sending it out to do other deals. Potentially, you could have a higher return if you're doing more deals, but obviously as an operator, that is a lot more work. But in this section, talks a lot about recourse debt, taking people, out of deals at the right time. If it's whatever that approach is, should you take them out or not? In Jacksonville, Florida, we're doing a lot of deals. We're seeing a 57% upside in the rents, so meaning $1,000 a month current average rent with a value add deal, Class C apartments. Come in and do some renovations of $6,000. You're seeing the new rents are $1,560, so almost a 57% upside. So that provides a margin of safety, right? New construction, it's challenging to get a margin of safety in there. That's why I love value add deals. But the larger you get, the more challenging it is to do value add deals. But Ken talks a little bit about the standoff that happens between buyers and sellers, right? Sellers are looking back saying, well, this was worth this much. It's still cash flowing, rents are going up. And buyers are coming in saying, yeah, but there's more risk here and debt is more expensive. So let's jump into that.
I don't have it. Even during COVID, when everything got shut down, we took a look at our stress test, which is basically debt plus expenses. What's our break-even occupancy? We're fine. And so I think there's a spot that you should be comfortable with. And if you can scoop that money out, fix it long-term, be happy with it, and you're cash flowing, the key is cash flowing. As long as you're cash flowing and you're happy with that, and then now you're just using what I call OPM or other people's money. You're just borrowing from the bank off your own properties. But the key is, of course, making it work at more than what you're borrowing. So, it's a great way to harvest cash if that's the game you're in. We, of course, have both. So my history has been one-offs, like bucks. And what I found with the fund was a couple things. One, having that committed capital helps you when you're actually negotiating with the seller. So, you think about a seller and you're trying to buy a $75 million deal, and you're like, well, I have a fund and it's got committed capital in it, and I can close tomorrow, put debt on it later. I can, whatever. You have a lot of options. The other thing is, in ours, you could have 4 or 5 properties. So you might have one that's doing, let's say, 5% cash on cash, one that's doing 8, one that's doing 2, one that's doing 9. And so you get the blended, returns from all of those. And they're all, it's diversification inside of, one big fund. The negatives are the fees and some other things, of course. So we've done both and we've toyed around with both. We like both because it enables you to maybe stretch for something that you might have a big value add on that has a lower cash on cash. So you might pair it with one that's 8 or 9% cash on cash, as an example, and has a really good return. But you could stretch for something that maybe has an $800 or $900 rent lift in it. You might not see it for 2 or 3 years, but it'll eventually catch up. So it's been good for us, but I think with us, we're probably going to continue that way moving forward, just because it gives us those kinds of benefits. Yeah, it's all pretty competitive, Bronson. It really is. I mean, we're doing a lot of interest only, products too. So you can do 3, 5, 7, even 10-year IO or interest only. So there's all kinds of stuff you can do, and we try to pair it with the deal itself, and and then work backwards. So I don't. You guys probably do the same thing. You kind of take your deal, then you put the debt on it, and then you look at all the different kinds of debt, and some of them work well, some of them don't, and then you negotiate. Thank you, Bronson. First of all, thanks for putting this together. So we have a podcast called the Real Estate Strategies with Ken McElroy, and it's doing very, very well. We're a couple 100,000 downloads a month. We've got a YouTube channel that we just passed 300,000. So that's been great. KenMcElroy.com leads you to everything. You know, we're just trying to educate. I'm trying to make sure that if people are raising capital, that you know, that they're making money and they're making their investors money. So that's been my passion. Been in business 20 years, my partner and I, and it's a lot of fun.
All right, so some takeaways I got from this video from Ken. I always learn something when I talk to Ken, and it could be about life, it could be about investing, but really from this is just be really wise with your debt. As an investor, as an operator, make sure you're getting into the right kind of debt, so you're not getting into a place where debt could rise. Maybe there's no caps. There's stories I've heard of people not having caps on their adjustable rate, you know, kind of bridge debt, and that could really get you in trouble, right? We typically find deals where we're able to lock for 2 to 4 years and have some sort of fixed or a cap on things, but those caps are getting much more expensive, and so it's getting harder to do. So again, Ken talks about, you know, not avoiding deals, but doing the right deals, making sure you're working with the right operator, making sure that there is a margin of safety. Again, that's a Warren Buffett term of how do you, when things don't go according to plan, what sort of margins do you have in place? And so, you know, at Bronson Equity, if you haven't joined our investor club, I highly encourage you to join it. We have things in the multifamily space. We've got things in, we partner with the 5th largest operator of ATMs in the country. We've got other types of alternative deals. And if you're not on our list, you're just not hearing about them. So I'd love to be able to share that with you, set up a call with our team. You can click the link below or go to bronsonequity.com and hit the join button. We'd love to set a relationship with you. So again, if you're not following Ken, follow Ken, go to his YouTube channel, check out his stuff. He's amazing. Love to see in the comments what your biggest takeaway from this interview was, and look forward to hopefully seeing you on another video.